Welcome to episode 46 of Kontrarian Korner. I'm Ben Kelleran. Today we have a very special guest on to talk with us about opportunities in the Canadian market, most specifically focused on Canadian oil sands, energy, and real estate, and is definitely an account to follow if you're interested in some of those areas. And I think it'll be a great conversation, but it'll be interesting to kind of get his view from that side of the border because there's been lots of stuff going on with Canada as far as politics, tariffs, and things are changing fast. So, Roger, thanks for coming on.
My pleasure. Thanks for inviting me.
Yeah, so I know that we were talking before, and you said that Roger LaFontaine is an alias, and Nugget Capital Partners was just an account you started to kind of follow things, and you started a Substack to go along with it. But I'd be curious to hear a little bit of your background, and maybe if you could share with the listeners how you kind of got into focusing on specific areas of Canadian markets and kind of how you see opportunities. I'd love to hear about the in-house algorithm that you talk about on Twitter. I think that's one of the most entertaining parts of following your account.
Yeah, I followed energy over a decade now, right? And for the most part, I was bullish along that way. But when you start to go bearish and people start turning on you, especially some people that just never, they're always bullish, right? And then they're your friends, and then you become bearish. And it was the right call, right? After 2022, that Ukraine-Russian invasion was mostly the top for a lot of names, right? And then you become kind of like a lightning rod. So it's kind of, I started this account just to share some bearish takes, right, on energy in kind of a humoristic way, and they started out, getting very accurate, right? Especially in the past couple of years when everybody got bullish on this Hamas-Israel invasion. I thought this was a perfect opportunity to short oil, right? And these ridiculous names like Baytex and Crescent Point, Bavarian, and I don't know if you know them. They're horrible names in Canada, but they're very popular and they're touted by like high-level individuals like Garrett Nuttall and these people and every bank because they do so many deals and they have so much sell-side coverage. So, you started nailing these calls, right? And that my account started going a bit viral with the oil bulls in Canada, at least, probably not globally, right? But yeah, I got a lot of hits there, and then I started putting more effort into it, right? And then I created a Substack, and people started following me, and I was writing more just for my own entertainment, my research. So I thought I better give them as good a research as I could, right? So I've been putting more effort into that and trying to give them accurate views. But my interest in the past decade has mostly been energy and Canadian energy, and we've been through a lot, right? With I don't know how closely you followed energy in Canada, but politics, and we've had very unfavorable politics, and that's Trump to me is an asset for Canadian oil sands. I know people see him as an adversary, but I think he's an asset, actually. If you look back in the past decade, we had people like Trudeau and Notley, and you had Joe Biden, and you had all these people at once, right? And out of all places, you had a left-wing premier in Alberta, right, with Rachel Notley prior to Daniel Smith and Jason Kenney, and you had these people at the same time as Biden and Trudeau, and these was when ESG was at a prime. They're trying to shut down pipelines. You had bloating Canadian differentials and everything. Like you had all the headwinds that you could think of. So I think now you have a favorable setup in Canada. Even sentiment in Canada has changed with like people like so-called carbon tax Carney, our new prime minister that's not been elected. He's his first act of the day was to cancel the carbon tax, and this guy is like a climate banker, right? So even he's pivoted away from this ESG movement. So like people are not liking Trump in Canada, and I personally don't really like Trump, but he's to me a favorable asset for the energy sector, particularly because I think these people want more of the Alberta oil sands, and he's a very strong proponent, and other Republicans typically are too. So I think that's reflected in the valuations. If you look at Canadian oil sands names, even though oil's like $69, these names are hitting 52-week highs still, right? Some of them. So I think that's a reflection, and even with the tariff threat, is just a leveraging tactic, right? So I've been following that sector for a long time, and it's like in regards to your question of the algorithm, it's when you know these people and you've known them and you've read their post every day for 10 years. It's been probably about 10 years, right? And you see how people react and when these people enter and when they get bullish and when they get bearish and who they take advice from. And some of them are just so static, right? They don't change. So when this guy's getting in, that guy only buys when he gets confident and when things get obvious, right? And then you see these other people, they get in when everybody's getting skeptical and throwing the towel. So you kind of get that sense, right? When you follow these
Yeah.
people and you read their posts for 10 days and these weekly reports, EIA, API, and you have the same guys. Oh, we have a crude draw. Oh, the refining crack spreads are going up. It's time to buy. And oh, it's 200-day moving average has been crossed. And it's kind of funny, right? And
Yeah.
some people
Well,
only buy when and by that time, we're making 10-15% already, right?
yeah. I mean, it's interesting when you see the tweets of "we remain bullish" or whatever the kind of catchphrase is for some of these people. But when you kind of look at it, I think looking at sentiment right now for just energy broadly is pretty bad. But I do want to pull on one of the things you were saying. I figured we'd save the political side for later, but you kind of mentioned Trump being an asset for Canadian energy. I wanted to pull on that thread a little bit because I think that'd be an interesting place to go because there's been like a rise of patriotism or whatever you want to call it across Canada because Trump is kind of jokingly talking about Canada being the 51st state and talking about Trudeau being the governor and obviously not completely serious about some of these things, but it's stirred up some emotions, I guess, is the way I'd put it based on some of the stuff I've seen on social media. So I'd love to hear if you could dive a little bit deeper into Trump being an asset. Like, what do you think that looks like and kind of maybe tie that into the overall political situation in Canada? I think that'd be a good place to start.
Yeah, Trump is an asset. Like this is a guy that's very adamantly opposed to things like carbon taxes and ESG movements and electric cars. He's already upended, I think, Biden's mandate on electric cars, and that was a bearish thing when you hear on the news that Quebec is going to ban gasoline cars in 2030. That's like tomorrow, right? That's 5 years, and now this is a distant memory. So Trump's mandate to get rid of all this electric car and ESG narrative is like upended everything with the ESG movement. So naturally, I think that's bullish for oil. And he's already said he wants more oil. He's open to Keystone XL being resurrected, right? And last time he tried to persevere that line into, it got blocked by that Montana judge. But he wanted that pipeline built, that Keystone XL. So I think just like in that regard, he's very positive. And so I think he's going to try to get another pipeline, especially if shale ever weakens. I think that, their natural ally is in Alberta, where you have 100 plus years of low decline oil sands. So especially if this Mexico situation down there, I heard it's getting worse with the Pemex. Their production is falling and recalling. So I think Alberta is going to be building more pipelines sometime if oil is going to stick around. And but in regards to your other question there, I think he's. I can't believe what the Liberals have done. They went from waving like social movement flags, like gay flags and Ukrainian flags and every kind of other flag in Canada. I walked by Trudeau's office last year in Ottawa, and he only had a gay flag. It was a gay week, and not against it, but I mean, how do you go from all I see now in his shows is Canadian flags? All of a sudden, these people went from accusing you of being a racist for having a Canadian flag and being a trucker. I don't know if you remember that convoy movement. They were associating the Canadian flags with truckers, and now they're waving them and saying elbows up, and like this is a total shift. I don't know how they did it, and now they're leading. I've seen polls that Carney is in the lead with a majority. I can't believe it. And even in Quebec, he's in the lead. He can't speak French, right? And he's in the lead here. And these people were not pro Canadian flag people in the past 5 years. They were social flags, orange T-shirt day kind of people. Like every kind of social movement they could replace the flag with was, there. So the Trump has spooked them, and he's done such a solid to the Liberal Party, it seems. And I thought he did us a solid too, getting rid of Trudeau at first, but Carney is there, and apparently he's strong. That's real. So I don't know how they did it, but Trudeau is an attribute to that, right? Trump is an attribute to that.
I think too the thing with Carney that's interesting is I think the approach, at least from my cheap seat view of things, is the anyone but Trudeau has kind of been the mentality. And so as soon as Carney kind of popped up, and now he's like surging in popularity, apparently, according to polls. But I think there's a decent chance he could end up being worse, right? I don't know if there's a way that the carbon tax makes a return after he gets, if he wins, the election if the carbon tax would come back after that. But I think people look at Carney and see like, oh, he's this polished figure, politician, and been like former central banker, so he knows what he's doing. And I kind of look at it as like, that's trouble. Like if he ends up winning. So I don't know if you have any thoughts on if he could bring the carbon tax back, or if that's what you kind of see depending on who wins the election that I think is coming up here pretty soon, if I remember right. So
April 28th.
Yeah, so about a month.
I think it's the 28th. Yeah. Yeah, well, he didn't actually drop. My understanding is he's keeping the industrial portion of the carbon tax. So the big companies are still going to have that disadvantage of paying the carbon tax. He's only dropping the consumer carbon tax. So our pump price is going to drop 17 cents. But he's going to keep the industrial carbon tax. That's very good for Trump. And that's probably why Trump prefers Carney. He said that he prefers him over the Conservative Party because he's worse for Canada. That's better for the competitive nature of the United States, I think, and manufacturing in the United States. So, you know, I was kind of telling people Biden win would be good for Canada because he's worse for the USA, and you know, Trump is better for the USA manufacturing wise. At least I thought he was. So, perhaps he's taking that mentality right. So I kind of was telling people I thought Biden would be good because we're going to have a conservative government, and he's going to make favorable policies for businesses, which will make Canada attractive. But it's gone the opposite way now. We're getting a liberal majority under Carney, it looks like. And I don't know if Trump is good for the USA or bad anymore. He's doing weird things. So yeah, I really don't know. But I think Carney is he's smart. He's read the winds, right? He's catered to what the people want. They wanted rid of the carbon tax, which was a mistake. It was introduced at the height of the shale revolution when oil was like $40 or $50, and nobody noticed a spike. And it started small, and it moved up every year. So as it got bigger and people got poorer and inflation got worse, then that carbon tax became very unpopular, even in places that used to be popular. But that Carney's not dropping the industrial carbon tax, and that has downstream costs, right? Even in the refining sector, it's another carbon tax on top of a carbon tax, and they just call it something else, but that's paid for by the consumer, right?
Yeah.
So it's really, this Carney guy is a climate banker, like you said, right? And he knows all these mechanisms to hide these hidden taxes. And he's pretty much said he's not going to backtrack on that, right? He wants to have these industrial so-called polluters, which are AKA the employers, pay for these the carbon taxes and ESG centric movements. And he says that, you know, just he wants to withstand Trump. He's working with the EU, like-minded ESG centric people, right? And that's where he made his first visit. So he's hoping that he can save the green movement. And I have another account on Blue Sky, and that's kind of where all the green energy people migrated to. And I kind of read what they're thinking with Carney, and they're hoping that he can just kind of, suppress Trump for 2 years and then see that Republicans hopefully get wiped out, and then they can bring back their crazy ESG movement. So I think Carney's reading that, and he's just, catering to the population. He knows it's good for votes, right?
Yeah.
And now all of a sudden his agenda has become patriotic because Trump has become attacking Canada and sovereignty, and just it's bizarre. I never would have imagined this. This is like 1,000,000 odds, that we're talking about a liberal majority now after Trudeau. Like, this guy was on the path of, I thought his whole party was going to be decimated. Like, I didn't think they would hold party status. Like Ontario, they lost party status. That's the most liberal province in Canada, and the Liberals have lost party status under the prior premier, Kathleen Wynne. So to see these guys like make a resurrection, like Lazarus, in the Bible, they're just back from the dead. It's crazy, and that's all because of Trump, I think.
It is interesting to see with what's going on up there. I guess the big question is, do you think Carney kind of keeps this momentum and he wins, or do you think Poilievre is actually going to be able to get people out to the polls and have a better showing than maybe it looks like right now?
It looks like Poilievre could win a minority government, but that kind of is still a deadlock government, right? So I don't know who's going to win, but it doesn't look like a conservative majority. That looks certain. So whether Carney or Poilievre win, to me, no longer matters if it's a minority government, because you have to depend on the Bloc Québécois and these, depending on your angle, right? If you're an energy investor, basically nothing changes, right? So, and as a REIT or a Canadian energy investor, a real estate investor, perhaps the Liberals might even be a little better than the Conservatives. So I don't really see this this election as impactful as it was. When we're talking a majority conservative movement, then I would have thought this is very good for the resource sector in Canada, right? But now you have the Liberals talking about being pro-resource. You saw the far left premier of British Columbia. He responded to Trump saying he wanted to expedite these 19 mining projects and energy projects. He got a midstream project going for natural gas fracking. It's like unheard of to see a left-wing, somebody I considered kind of like a far left-wing leader talking about resource extraction, and we have to get it done quickly, emergency. Like, this guy would put every roadblock in the world until Trump got into power. Now you have the left pushing for Canadian resource extraction. So does it really matter? I don't know. Because, all of our pipelines are built now. We don't really need another pipeline. This is kind of a talking point to people in that industry, but I don't think you need another pipeline anytime soon, right? Out of Canada, differentials are very good. The demand is not really, growing as it used to. And you have a lot of natural gas capacity already. And these natural gas pipelines are going to be all First Nations and provincial issues, nothing to do really with federal governments much. So I think the impact is overrated now for this is not like 10 years ago where you had really, really a problem politically for energy. Now you have kind of the infrastructure in place for energy now. And I think that you can see that with the multiple Canadian names are not trading at huge discounts anymore to the United States producers. And I think the oil sands producers are trading at a premium now to a lot of names in the United States, which was unheard of before, right? So I think that impact is overrated, right? But if you got a majority conservative government, that would be different. But if you get a minority Poilievre conservative government, that doesn't really change much, right? Because you're still dependent on the left-wing parties of the Bloc Québécois and the NDP and the Liberals. So
yeah,
I don't really have big views anymore on the political scene here. And so much is dependent on the US, right? Because Canada can't shape the global economy, right? You don't have the population. So if Trump upends the ESG mandate on electric cars, what is Stephen Guilbeault, the environment minister, going to do? He can't force us to buy electric cars, right? When the United States is not following through. And you have a polar opposite government there that's upending any kind of ESG initiative. So
yeah.
I think the Trump situation is way more impactful for us in Canada.
Yeah. I think it is interesting to kind of see the relation between the US and Canada. I guess the last thing before we get into some individual names, you mentioned that Trump wants the Keystone XL pipeline. He wants to revive that project. But after the last go round, right, who's going to take that on if, right, they saw what happened the last time it basically, right, blew up. But who's what company you think would take a chance on something like that?
Well, we saw that Plains Midstream sold their TMX interest to the Canadian government, but I think if the government backed them, I think the U.S. companies like Plains Midstream and these kind of companies, they might be interested, right? I don't know if TC Energy would be. They kind of wash their hands with it, but then split into two companies. One of them is called Sobo. So they're just handling the Keystone pipeline that's already built. But maybe if they have government backing, they could get into that, right? And you see them talking now, it's an energy emergency. That's the term they're using, right? In USA, Chris Wright is referring an energy emergency, and he's a really smart guy, the fracker that's now, the former Liberty CEO. And he does business in Canada before, right? Liberty Oilfield Services, and he has a very good relationship in Canada. So I think now you have Premier Smith there. She's very adamant about these pipelines, and even Carbon Tax Carney, he's open to this pipeline. I don't really see him as an anti-pipeline guy like they do, right? He's built pipelines around the world with Brookfield. So, as long as you accompany these pipelines with these carbon tax initiatives, or not carbon tax, sorry, the carbon capture initiatives, I think that they can get these pipelines socially accepted by even those kind of people. So, but I don't know, with the latest Trump rhetoric, anybody wants to build to the USA. They're talking the One Energy East. I think that's harder to build than Keystone XL because you have to cross through Quebec and these places that don't want pipelines. But I think you have support for that pipeline, and federal and both sides of federal and provincial and state. But the last time it got blocked was from that Montana judge in the Ninth Circuit Court, right? So I don't know the legal situation there with the U.S. judges. They have a lot of power, right? If you remember, I think his name was Judge Morris, and he blocked it, just one decree.
Yeah, I think it'll be interesting. There's obviously a showdown being set up between the legal side or the judiciary and some of the judges there and Trump with some of the executive orders on stuff like immigration or what's going on in the military. And if you look at the way the Constitution sets things up and plenary powers and stuff like that, I think the Trump administration has a slam dunk case on that front. But it will be interesting to see if they can get something done as far as a pipeline. But to move on to the energy names, and one of the, like, I think it'd be interesting to get your thoughts on some of the different individual stocks that you like, because I've looked at oil sands for at least a couple years and they always look cheap. And I always kind of look at it as the whole sector is basically a minefield. And if you aren't very familiar with it, you're going to step on at least one or two mines if you don't know what you're doing. But I guess the big picture question is, what do you look for when you're kind of evaluating some of the Canadian energy companies?
Yeah, the oil sands, there's not many companies left, right? You have the big players, and my only investment there is in Strathcona, which is probably the kind of lower quality one there. It's still a good name, but it's lower quality compared to MEG and CNRL. But yeah, these are all companies that have done their upstream kind of investments many years ago, or a number of years ago, and then they spend so much capital and those, like you said, they're mines kind of, right? And they pump steam in and they soften the ground and then they extract the bitumen, which is very thick, and they mix it with diluent, right? So I'm not an expert at geology, but the existing Canadian public companies that are there that are remaining are all relatively low risk names, right? You do have one company, it's called Cardinal Energy. They're doing a greenfield project, but they're not even an oil sands operator, but they're trying to get into that business, and that's, like you're saying, is risky, right? And people have acknowledged that risk. But the names like MEG and CNRL and Athabasca, these companies have been de-risked in my view. So, I mean, they're not risky names, right? Other than commodity price now and other political issues and pipeline differential issues, and they've been de-risked, right?
Yeah.
So I don't. We only have a handful of names now left, right? So I don't see them as risky names, right? And Strathcona and NAPCO perhaps are a little bit more risky because they're doing some organic development there, and that organic development costs so much money. But I'm not the best one to talk about the geology of the SAGD projects. I could recommend you some guys that know that and could talk in depth, but I don't want to go over my head and make a fool of myself, right? But these other names are very developed and proven out and de-risked, right? So I know about the marketing elements of them, like Cenovus, for example. You have that's kind of why that name is weak, because you have the downstream element to it, and then you have like a Suncor, which has the integrated nature where they can process all of their bitumen on site, right? And they could render that into downstream projects, so you don't have any impact to the differentials or any oil differentials. You're able to, even buy barrels from other producers and produce and put that through your downstream and Suncor, right? But then you got these other ones like Cenovus that have the asset in Canada for the upstream side, and then the downstream side is in the United States, right, where you have a number of refineries in like Toledo and these places. So that's kind of why that one has been weaker. So I think there's other different elements to look at the oil sands, because some of them are pure play upstream, and some of them have marketing abilities, like through refined product side or storage side, and then you have other ones that are more sensitive to natural gas, and they have to buy condensate on the market, and there's different nuances to them.
Yeah, it's interesting because there's companies like, I know my friend loves to hate on Baytex and a couple others that are clearly not the best place to be. But as far as like looking for buybacks, dividends, like capital returns and how that's structured, are there certain things that you look for when you're looking at, okay, like I prefer lots of buybacks, or I'm fine with ones that pay out pretty sizable dividends, or what's your thoughts on that front?
Yeah, I think the buyback is making sense, but it's variable depending on the producer. Like you mentioned, Baytex. This is a company that is unlike the oil sands, which is like where you have all your costs up front. You take on the debt, and then you're very much a cash machine, right? And you're low risk. Your deposit has been proved out, and you're just dependent on the commodity price more than anything. But this Baytex, for example, they're obsessed with doing buybacks, and to me, this is a smokescreen, right? several $1 billion of debt. You're a short cycle producer with a huge high decline rate. You're trading a weird macro environment. You don't know what's going to come next, right? And these guys are not, they have like 10%, 10% interest on US based loans, and they're worrying about a buyback instead of paying debt. So to me, this is a disaster in the making. I think the market has recognized that, right? But they're not moving away from that, which makes me even more suspect that they're still trying to suck in the fools. But if you look at a name like, I was bearish on this name. It's called Athabasca Oil. I'll concede that I was wrong on this one. And I was just kind of a management issue, right? I thought these were so-called shitco managers. They don't care about their investors. They never buy back share. They sell at any opportunity they can, right? But this is a company that they were created basically by Statoil, which is a Norwegian company when oil sands was in vogue, very popular at the time, right? So they spent billions and billions of dollars. And they went down to like 14 cents during the COVID lows. They could have went bankrupt, but probably nobody wanted their assets at the time. And they made a remarkable recovery, and they're buying back more shares than anybody. That's all they do is buy back. But they got that asset in place, right? And now they're just kind of like a free cash flow machine. Even they might trade at a high multiple. The market has accepted them as a buyback machine. So when you have like an 80-year asset and you can buy back like a normal business, and you're not really gun to your head with a commodity price like a Baytex, and you have debt. These guys have almost no debt. So it's like a debt-free operation versus a high debt operation. And you have the low risk deposit. You don't really have to invest much in your upstream CapEx. So I think the buyback is making very good sense for those oil sands names. So I think that ATH is called ATH.TO in Canada. That's been an exceptional performer from the buybacks. And now you got another company, Meg Energy. I don't know if you know Meg.
Yep. Sort of familiar with them.
Do you know them, Meg? Okay, so Meg is another one. They had a lot of debt, and now they're kind of pursuing the same strategy. They bought back their public debentures, wiped out all their debt, and now they're going to focus on the buyback. So, and when you're able to buy back 10%, like to me, that's a lot of shares, right? But you see these other fake buybacks, I call them, when like even CNRL, which is like the most respected name in the space, these guys bought back 1% in the past year. They're paying out all their money in dividends. So how do you win like that? It's an overrated buyback, and then they tend to issue shares to the management, and then sometimes you see that too. So I look whether it's a real buyback or not a real buyback, and I don't necessarily love buybacks in that space. I do in the real estate space because you have like a multi-decade asset, right? It never goes away. But in energy, you have a declining asset base usually, right? So for the oil sands names, it makes a lot of sense, but for the short cycle names like a Baytex or Crescent Point and Barron and these names, it doesn't make sense. But it really depends on your debt situation and whether the management is just dumping on you with new share issuances. And you see that a lot in Canadian energy, where they issue shares to each other and then they file a buyback. They get all these sheepish kind of investors on Twitter and like retail investors that don't know better. And they post about the buyback. It gets 100 likes, but they don't realize that the share count isn't going down and the debt is static. Like, what is the point of a buyback if your debt isn't going down? Your company is getting more risky, right? Like Baytex is a perfect worst example of that, right? They've taken on more debt and they're doing buybacks, but their debt isn't really moving, and the company's riskier than ever, right? And you have a limited reserve life with those names, unlike the oil sands names like an Athabasca or Meg Energy, which has multi-decades of inventory and low risk inventory. So, that's I think you have to look at the debt situation and whether the management's issuing stock and what their viability is, right? Like the risk to the company, because some of them have to invest a lot more than others when it comes to CapEx and upstream operation. And there's a lot of nuances there. But the buyback is not a white or black answer, right? In my view. But particularly with energy, it's really a case by case.
Yeah, it depends on
the situation. If you look at Peyto Energy, that is a name that's really impressed me. Peyto is a gas company, and all they do is pay big dividends. So I thought, if you thought your stock is cheap, why don't you buy back? But the investors love it, and Peyto is at a 52-week high, a 5-year high today, and gas prices were in the doldrums for the past couple of years until recently, and that name was churning out 52-week highs just from hedging the NYMEX exposure. So to me, that's a good example of a dividend name in energy. They pay monthly dividends, not quarterly. That attracts a more retail investor crowd, and they've gotten a very good multiple, and they've gotten like stable trading. They don't trade like a yo-yo, right? So to me, that's like, if you're asking me the best example of a name like that, first as a buyback name, those two have impressed me. And yeah, I have to admit I was bearish on Athabasca Oil, but these guys have done a very good job with buybacks. I'm not buying it, but it shows you how you can win with that buyback. And Peyto is showing how you can win with a dividend name, pure play dividend strategy. So
before we kind of move on to Canadian real estate, I'd be curious to get your thoughts on the deal between Whitecap and Varen, because that's been one of the more recent pieces of news I thought was interesting. It's maybe a little bit outside my wheelhouse, but I thought it'd be good to kind of get your opinion on it and see what you think of that deal before we move on to some of your ideas in the Canadian real estate sector.
yeah, those two have been like peer groups for a long time. Even before they were in the Montney, they were in Southeast Saskatchewan, and they're side by side forever, right? And Varen, so-called Crescent Point before that, never had insider alignment. So I was always negative on that name, and it was always a kind of a popular name in Canada, but it was never ever able to outperform. And Whitecap is really, they have a better management team, but they're not much more respected, I don't think, by the market than Crescent Point. But I think it makes sense when a synergy, when you have those two companies that are like side by side now in an out of favor sector. But I don't think that's done as a positive like people are thinking. You know, you have an unsustainable, I think it's an unsustainable dividend over the long term. When you have now $4 billion of debt almost between those two companies, that's more than some oil sands names. Like that's more than Cenovus has with almost 1 million barrels of production. And these guys are a short cycle name, lots of exposure to AECO natural gas, high decline rate, and both of them have been doing so many M&A transactions with these smaller companies. You're basically like a giant Explorco now. So they have to go and find good spots in the Montney. Yeah, so it's lots of challenges, I think, to that acreage. And you have a dividend that was questionable, and now I guess they're hoping that merging them can help that and create synergies. I think they said they have $200 million a year of synergies. But my thought is that they only did that transaction on the Varen side because you probably don't have any big M&A suitor coming in saying, I'm going to give you more money, right? You have no alignment on that management team. And I just can't imagine that being positive for the Canadian M&A scene. They said it was done at a 40% premium, but Crescent Point is not up 40%. This is a fallacious premium, right? And Whitecap fell after the deal. It's still lower than it was for the deal. And I just don't think there's going to be a horde of new investors that want to go into those names. I'm very skeptical, even though it makes sense, like fundamentally, that transaction. It's just, I don't think it was done. It is telling me that there's no M&A bid out there. You saw a couple others, like Advantage is another Montney name. They said, we're going to do a strategic review. But you do a strategic review if you want to sell the company and there's an M&A bid lingering out. We haven't seen very big, M&A deals for a while now. It's like kind of like, is that spaced right up? There's no U.S. companies that want to come in. And, when you're just doing mergers now is kind of uninspiring to me. Unless you're a long-term oil bull and you think this is going to help you in the long term, which is possible. But those two companies have a lot to prove, right? And now you have high debt. They won't admit it. They go by net debt to EBITDA and say, oh, our net debt to EBITDA is still low. But these are a high decline, higher debt situation now. And if your debt isn't going down and you're having an 8 or 9% yield, does that make sense? To me, it doesn't. And it's a dividend dog stock now. I think that whether they make something of themselves is possible, but I'm not getting involved in that. I don't think much of it. And they incorporated some of these Varen Energy Management now. They gave them 6 board seats, including the CEO, who's a disaster in my view on the Varen side. I don't think that will be attractive to investors on the Whitecap side now. Even though that Grant Fagerheim is a more respectable character, and he has I think 3 or 4 million shares. It's just lots of questions still, I think, with that name. But every bank and these guys will tell you it's a very positive transaction. But I'm very skeptical. I could be wrong in my skepticism. I've been wrong before. But I think they're just trying to save face. And I don't think there's a bigger M&A bid out there. I think that's demonstrated now through that and several strategic reviews that have been announced with smaller companies. It's like there's nobody knocking on the door for these assets, right?
Yeah. No, I think it is interesting to see, but I guess I do have one last question before we move on to real estate. And I guess looking at some of the opportunities in Canadian energy, if you had to pick like 3 names right now, what would be your favorites? Like what would be at the top of the list as far as if you're putting new money to work today, what would you be looking at?
In Canadian energy?
Yep.
Okay. Well, I would go with Strathcona. And I guess from these values, I might go with Precision Drilling, and I would probably go with maybe Total Energy.
Interesting.
Oil field service names, and Strat, which is a name I think will get eventually a multiple re-rate, but Precision Drilling is rated as like the low. Is not a buy and hold name, but it's a very good trading stock. I think you can make a lot of money here. They have the monopoly over the Montney, which is not slowing down much. And they have high spec rigs, super spec rigs, and they also have a super single dominance in the Clearwater, which is seeing a lot of activity. So I think Precision Drilling could go up quite a bit from here. And Strathcona, I think that name is going to it's getting respect. It's getting people like Fairfax involved into it. So I think Adam Laderouse is a very smart person, and we're still seeing insider buying at the current levels. And that name is like 94% held by one party. So as liquidity opens up, I think that trading liquidity itself could help that name get a better re-rate over time. And above 70, that Strathcona, which is mostly an oil sands asset, can really catch up to the other oil sands SAGD peers that we talked about. It's trading at a huge multiple gap. So that one has a lot of potential over the long term, and they have like 30, 40 reserves as well. So, and then the last one I told you is Total Energy Services. The CEO, Dan Halleck, he's buying shares all the time, and he owns 10% of the company. And they have no debt now. They're in a perfect position. They have US, Canada, and Australian operations, and they're very high margin operations in the US and in Australia. And their client roster is very defensive. And as we talked about, that Trump is bullish oil. He wants more Canadian oil, and everybody else does too in Canada, even the left-wing people now. So I don't see that slowing down the drilling. And our currency is still quite weak, and the differentials are at under $10 WCS. That's exceptional for any Canadian producer. So I know nobody talks about energy services, but these names look quite good, right? If you're looking to buy and hold a name, I think you won't lose on that name. And it's trading at an incredibly low multiple. It's trading at like 2 times EV to EBITDA. So
interesting.
It's bewildering. I know I should buy it. I haven't added to it. I do have a small position in that, but yeah, and you look at that name, you say it hasn't gone down much, but you don't realize that they're buying back shares and they're debt free almost now. So
I do think it is interesting, because I've heard several sharp people that know Canadian energy better than I do start talking about Strathcona, and you're the first person I've heard kind of mention some of the service names, which I think is a place to look as well. But to move on to Canadian real estate, that's another spot that I think is interesting to talk about, because you kind of hear about Canadian residential real estate in the news and all this talk about that kind of subsector of real estate being in a bubble. But I think your focus on some of the Canadian REITs is interesting. I think you wrote up, was it RioCan, I think recently. But I'd be curious to hear your thoughts on the Canadian real estate market as far as the publicly traded side and where you're seeing opportunities there.
Yeah, the residential, I don't have any interest in these houses, right? I think they are probably low, but when you look at the REITs, that's publicly applied real estate valuations, right? So when you're able to buy something that you know is able to be sold for a more higher price, and you're seeing the transaction volumes happen, it's kind of hard not to be bullish. And in the past, if you remember, one of the names I liked was European Residential REIT. It's a Canadian listed name that's run by CapREIT, and they do residential rentals in the Netherlands. And they said they were going to do a strategic review, and they did end up selling half their portfolio, and they're up about 100% year over year, because the transaction gap, like the volume, the implied valuation between public and private is very big, right? So as long as you're willing to sell assets to the private market, and you can make money, and as long as you're going to profit off that arbitrage between public and private. So that's kind of what I'm looking to do here. And you have a very big valuation gap between public and private. And the bubble you're talking about is residential housing, and people read these negative headlines about Toronto condos, and that's kind of dominating. Familiar with that asset class, so let alone commercial names, right, where nobody knows how to value. I don't think commercial names very good. But if you look at one name like, for example, like Nexus REIT is an industrial name that I like, is in Ontario, and you're trading at like $140 on an implied square foot basis. and you're trading at like an 8% implied cap rate, but the deals are happening at 5.5% implied cap rates, and you're getting on average $175 per square foot. There's a huge gap to close as long as you're willing to sell assets into that private market. And it's things like retail assets retail is very, very strong right now, and people don't realize that the vacancy rate in Canada and also the United States is at an all-time low in certain areas of the retail class. So the retail class is incredibly liquid. You can sell assets at very good prices right now. So something like a RioCan, they have the best locations in Canada for retail assets, and they've actually started to sell some assets, and they started to buy back stock. So they got creamed over HBC bankruptcy headline, and that's like 3% of their NOI, but they're still collecting 70%, and they've fallen 12% since that story. So, but my focus right now is on the REITs that are willing to sell assets from the public to the private market, because that's how you're going to capture that arbitrage. And there's many examples of that. You're even seeing it with multifamily names in Canada right now, like Interrent and Minto. You probably don't know these names. I know probably the same strategy in the USA. You have some names that have been acquired at huge premiums, like Triton in Canada. They got acquired by Blackstone. They're 100% US multifamily, and that was done at a huge premium. That was last year. And some of my REITs actually in the USA, they've been selling assets privately in Texas, like industrial. They've sold some industrial assets from public to private market, and they're using the proceeds to buy back stock. And when you're trading at a 40 or 50% like discount to your IFRS value, and you're able to assets at 100% of the value to a private market buyer, like whatever the asset class, it's a pretty good deal, right? But people don't believe these IFRS values are real. And I think you have to analyze and scrutinize the NAVs, because I mean, in Canada, you have to, as a REIT, audit the NAV, and you have to hire auditors. So sometimes you see write-downs and write-ups depending on whether there's a number of sales, and then the auditor has examples of valuations in that asset class in that region. So sometimes you see cap rates expand or cap rates compress. I don't know if you know what a cap rate is, but you probably do. No. Yeah. So with interest rates, you have a lot of write-downs that have already taken place into these names, and you're at, I think, the peak cap rate expansion. And now you're starting to see cap rate compression, and you'll probably see more of that NAV write-ups as the cap rates compress from interest rates. And as interest rates fall, we're seeing more uptick in deals starting to happen. And I think in Canada particularly, we've been slower because you have this political uncertainty, and now you have the tariff uncertainty. It's kind of a double whammy, but you do have a favorable setup, and you have a lot of transactions on the sidelines that I think are going to take place. And I find it easy to find like the minimum value of what an asset can be sold for, but you never know what the maximum will be, because these assets have individual allure. But it's just your margin of error is so exceptional right now. It's when you're getting 30-40% margin of error between what you could get in the private market and where the public market's at, and you're buying back stock. Like most of these names are starting to buy back stocks now. And RioCan, which I've just added in the past few days, I'm getting almost a 7% yield on that, and that's still a low payout ratio, even if you assume the worst of the HBC NOI would never be brought back. But these assets that they have with RioCan are in the best locations in Canada, and they're probably worth more to the next buyer or the next tenant than they are with the current tenant. So these are things people don't know. It's not a well understood asset class. I can talk about it, and people just want to shrug me off. They don't even want to talk about it. They'll leave the room. They don't have any interest. It's interesting just because it's such a hated asset class, and the data is kind of transparent. Like one of the names I've been buying last year was Dream Residential. They're 100% US multifamily, and they're listed in Canada. It's a small cap REIT, very liquid. And like the big insiders, all knowledgeable people, were in from $13 at the IPO price, and they have apartments in Texas, Oklahoma. And just few weeks ago, they announced that they're going to do a strategic review. They went public in 2022, and that asset class has never caught fire since 2022. It's been in a bear market. So I believe they're throwing in the towel, and they're going to sell assets now, and probably just either do a big special dividend or whatever, I don't know. But I think they're going to fold up the REIT, and these guys were trading at a 40% discount to their net asset value. And we're seeing examples in these places like Oklahoma City and Texas selling assets at full price. and I'm buying this name at a 40% discount to where those transactions are happening, and they've been happening in the past month with one of the Canadian peers called a BSR REIT. So these are things I see, and I'm seeing a lot of smart people that know the asset classes best, whether it's office, industrial, retail, or even multifamily. They're all buying millions and millions of stock. Like, these people know their assets best, and I think we're going to see more privatizations in the space. We saw one last year, and it was a name I would never have guessed. I thought these assets are just so terrible, and they ended up going up 50% after that parent company tried to take out the remaining minority shareholders at a 50% premium. Melcor REIT, I thought this REIT wasn't even attractive to me, and the ones I'm buying are trading even cheaper, and they have better assets. So if somebody's willing to pay 40 or 50% for that name last year, MR.UN, I thought, I better start buying these other ones. And, people don't realize that these asset classes are liquid, like retail, industrial are liquid. Office is still tough to sell, but you can still get good prices for some assets in that space. But retail, industrial, and multifamily, I think, are still pretty strong asset classes in Canada and even in the United States. So, I mean, even in offices in New York City, and they've come back to life, and they're at all-time highs right now. So it pays, I think, to due diligence in these areas of the market that are not well liked or understood. So
yeah,
I think that space has so much potential. I'm very excited, and it's my largest holding right now, right? So by far,
interesting.
And I've been buying it.
Yeah, the question I have there is kind of the same question I had in energy, and maybe I'll kind of make it a two-part question, which is, are there certain sectors that you're more skeptical on as far as like real estate subsectors, and what are maybe three of your favorites right now if you're putting new money to work? I know you mentioned you'd been buying RioCan recently, but maybe what are two others that you think look really attractive right now?
Yeah, RioCan, I'm not sure that will be my top pick at all, but I have much bigger positions in Dream Residential. I would go with H&R REIT. It's one that's 50-50 USA and Canada, and they're actually 50% almost US residential, and the rest are like commercial class in Canada and States. But H&R, if I was going to tell somebody a name, I would give them that name over RioCan for a longer term play. And they're also in the process of selling a large retail portfolio. I think it could go up a lot over that. So yeah, I would go with H&R.UN, DRR.U. And the third one, I would go with Nexus Industrial REIT in Canada, NXR.UN. RioCan is kind of a short-term idea. It's just been oversold. I think we can make 10 to 20% on that and collect a big dividend. But I don't think you can lose money on RioCan. But the other three, I think you could make up to 50% on those names over the next couple years if the sentiment improves or the assets, right? Like the discount on H&R REIT is one of the larger cap REITs in the space. It's exceptional, and they've done all the downs. And when you're trading at 46% of their assets are U.S. residential, when very good U.S. residential, it's a very weird REIT where you have some Canadian industrial assets and U.S. residential many years, and just an out of favor asset class. But I believe the CEO there, he's ready to roll it up. He's 72 years old. I think he's the largest holder of that REIT, and we know that multifamily asset class in the U.S. could probably be sold to a private market buyer, whether it's like a Blackstone or a Mid-American Apartments. Any kind of company like that could buy that whole name out at a huge premium, and it's trading at an exceptionally high implied cap rate, like 8-9% almost. That is way too high for a multifamily dominated name, right? So, and Dream Residential, like I've told you, that one has gone black again. But they're in the process of hiring a strategic advisor, and I believe they're trading at like 8.5 implied cap rate. The market's at about 5.5% according to the latest CBRE data. So, and that one, I think they're throwing in the towel. They realize that there's no appetite for a small cap REIT. They can't grow. They can't get cheap debt. So I think they're just going to sell their assets. And in the past month or two, we've seen some pretty good examples in that, and sold off on the trade war, like trade war of Trump. Everybody said, okay, a trade war is going to shut down Ontario. So I thought that name could go up a lot. It's one I started buying at $6.50, and I was buying it all the way up to $8. It's back to $7. So sometimes I take profits, but that one I averaged up. I totally underestimated Trump's trade war damage. I never thought this guy would be so aggressive and cuckoo, right? But that one is fundamentally way better now than it was last year. The dividend, which is 9%, is fully covered. And that's coming from net operating income, rent resets year over year, and new organic developments that came online. And they just sold a string of non-core assets to deleverage. And now they're a pure play industrial REIT with another major retail sale coming that will make them 100% Canadian industrial. And they'll be the only Canadian industrial REIT. So this one, again, I believe they're trading at about a 50% NAV gap, and the NAV to me is real, and they're worth more now than they were when they were $13, but people got spooked because of the trade war rhetoric. So I think that name is going to go up a lot if we can get any kind of traction with the trade war. And even if we don't, the Ontario population needs industrial asset class, and they have a very minimal presence with the automotive sector. So, yeah. But when you're asking me the other question about where I look for caution, I think that you have to analyze the NAVs and what the company's assets are individually, and not just take a blind NAV and say this one's trading at a 50% NAV gap or 30% NAV gap. Or you have to look at recent transaction trends and kind of have an idea of what those assets are worth and whether there's a catalyst there, right? Because the people that haven't done that are just investing in dogs. And when your asset class is out of favor, I think you need a catalyst to kind of advance. Like lately, the catalyst has been selling assets to private market buyers. And unless you're going to get like a sector rotation into that asset class, it's hard to see like a big upside, right? So I think you have to find like I had last year with Ares, where they sold their entire portfolio to the private market. And we're seeing it this year with Dream Residential, and seen it a bit with a couple other ones on a smaller scale where they're selling portions here and portions there. And I think we're going to see more of that and more privatization. So those are the names I'm trying to identify. Yeah. And kind of hope for the best. But I'm doing everything with very extensive research, right? I'm not just taking a blind NAV and saying this one's trading at a discount. So I've done extensive research into the space, and particularly on the transaction liquidity front.
As we start to wrap up here, I do want to ask one kind of last broad question as far as Canadian-U.S. relations. But I've kind of said that in my lifetime, I wouldn't be surprised if the U.S. absorbs a piece of Canada. I think Alberta is probably the most likely of all the provinces to potentially make a move like that. Do you think, depending on how this election turns out or how things develop between the U.S. and Canada, that is unlikely? Or do you think there's some long-term changes that'll be interesting to watch as far as the path for Canada being kind of independent state in its current form? Or what are your thoughts on that front?
Yeah, I think Alberta has a problem that the big populations in Calgary and Edmonton are left-wing. If you look at the mayor of Calgary, she's a radical left-wing lunatic. Like her name is, I don't even remember her name now, but the previous one was Nenshi, and he's still around, and he was a multi-elected mayor. So say all the guys in the small towns in Alberta want to separate and join the United States, how can you get through Calgary and Edmonton? Edmonton has a former Trudeau bus driver as their mayor, so that's where most people live. So I don't see that happening. Those people are staunch left-wing people, and they outnumber the people that want to separate, who probably would love to separate. And I think it's similar here in Quebec, where you have separatists that are in the smaller towns, but the big city is dominated by the people. And you can't get through them, right, unless you strip their right to vote. I mean, I'm not against the idea. I think that would be pretty cool, actually. USA and Canada as a European Union-like country, or region. But I don't think those people in Alberta are going to be able to get through the lefties in Edmonton and Calgary. That's where most people live, right? Yeah, and they're at 40% or 30% that want to separate. That's just not a strong enough number. You saw it in Quebec. I don't know if you know Quebec, and that's on the other side of Canada, and you have similar numbers of people who want to separate, and they were at almost 50%, and they still separate. So, yeah, I don't know about Alberta. I don't think there's any hope there, but you might hear more rhetoric. Yeah, I'm not against it, really. I think that's comparable cultures, right? But people will shoot me for saying that, but I kind of like the idea. I used to live on the border. There's not much difference, right, between Michigan and Ontario. There's no difference, actually. What do you think? Well,
I think you see kind of the return of the Monroe Doctrine with talk about Greenland and talk about parts of Canada. I think I think it will happen in my lifetime, but I don't think it'll be soon. And I think there's just certain trends that are durable that I think are going to continue. I think it's probably going to take a generational change to see that political will start to shift. But I think the oldest generations, even here in the U.S., they have a very different view of politics and what should happen versus what is and all these different things. But I think it'll be interesting to see, but I think it's more not anything that's imminent. I think it'll be maybe something that's like longer term, out 10, 20, even 30 years or more. So that's kind of my view. So as we start to wrap up here, I do have to ask you my traditional closing question, which is what book should I add to my reading list? Can be history, finance, investments, anything you think would be interesting.
The Frackers, that's a good book.
Okay. Yeah, I'll have
With Howard
to.
Hammond story. Do you know that one?
I've heard of it, but I haven't gotten around to reading it.
It's very interesting. And it talks about the North Dakota oil scene. And I love that book, and great for energy people.
Yeah, I'll definitely have to add that to the list. My reading list keeps getting longer and longer, but I think it'll be good to kind of catch up on it at some point. I think that'll be one that definitely is interesting as far as energy goes. So I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.